mentioned this, Amy, but like when clients get really realistic, it usually becomes apparent that at least one, if not more than one child will not be able to afford to take that cottage.
Life, money, action.
Welcome to Small Change, Big Gains, the podcast where we explore how small, intentional decisions can lead to major results in your financial life and personal growth. Whether you're looking to invest smarter, develop better habits, or simply find balance, we'll learn together how minor shifts can make a big impact. Join us as we unravel experiences, explore practical tips, and hear inspiring stories. Let's make it happen, one small change at a time towards big gains. Welcome to another episode of Small Change, Big Gains.
Welcome, everyone.
Welcome, Jessica. We are lucky to have in-house today Jessica Elie, partner and head of estate planning with Loopstra, Nixon here in Toronto. Jessica, welcome.
Thank you, Amy.
Glad to have you back.
Yeah, nice to have you back.
Happy to be here.
So today's topic is equal versus fair, which sounds like, what does that mean from an estate planning perspective, Jessica? What does that mean to you?
Sounds like a Netflix special, too.
Sounds like, yeah.
Like the cruise ship ones?
Yeah.
Yeah, I mean, it can mean a number of different things, but I think where I come across it a lot with my clients is, you know, not every family is built the same. Not all the dynamics are built the same. We're not all, spouse with 2.5 children from the same marriage and, very divisible assets.
Right.
And so there's competing needs there, competing circumstances, and how do we deal with that? And that can be, often it's with clients that have businesses and they have more than one child, and maybe one or more of the children are not involved in the business and one or more are.
Right.
But we also have where one or more children are more successful than the others.
Right.
And one or more children might have more of a need for funds once they're gone. And maybe they give support financially to those children now that they want to make sure continues or might have an obligation to continue.
Right.
And so it can mean a number of different things, but it's something that we're often in discussion with clients when we're talking about their estate planning.
It's where estate planning can get complex because it's not, to your point, it's not just we divide 50-50 and away we go, because people have stuff and assets aren't always easy to divide. A good example that we run across all the time is family cottage. And it becomes really, really awkward, right? You have a bunch of kids, maybe some live nearby the cottage, some are interested in the cottage, maybe can't afford the cottage. Who's going to pay the capital gains? How do you divvy up these assets to accommodate, if it is important to you that to pass on that asset? How do you do that?
Yeah. And the cottage is one that we obviously talk about a lot. There's various ways, right? I always start with, have you had a discussion about this with your kids? Let's assume they're trying to give it to the kids, right? Have you talked about it? You'd be shocked at the amount of times they say no. Right? No. Which I get, right? It's a delicate topic, especially if it's really like the family cottage that everyone uses every weekend, every summer. And it's a gathering place, and you kind of shy away from having that conversation. Completely understandable.
Well, parents don't really want to talk about it, and then kids will, even if the parent does try to talk about it, the kids will be like, what are you talking about? Like just kind of, it gets shut down, right?
You're never going to die.
Yeah. You're going to live forever. Yeah.
So I always like to start there, and I'll give clients sort of some jumping off points, because you mentioned this, Amy, but like when clients get really realistic, it usually becomes apparent that at least one, if not more than one child will not be able to afford to take that cottage on. Because remember, you're gone. You're not paying for the ongoing maintenance and expenses. And so let's just say there's 3 kids and you're assuming that they're all going to take it on and split everything 3 ways.
Right.
Is that a financial reality for each of those 3 kids? It's sort of where I like to start.
Yeah.
And sorry, here by financial reality, you mean what if one of the kids cannot afford his or her piece?
Yeah. I mean, like it's often, almost always the case that not every child's in the same financial position themselves, right? And they're in their situation. And so, is that realistic, right?
Well, and is it realistic that they will all share it equally, right? Because we'll often see that there'll be the one that does all the maintenance and pays the property and does all the grunt work, and then resentment builds up, and then it all kind of implodes at some point.
Sounds like you got some stories.
Yeah, we've seen it all. We've seen it all.
Yeah. So there's like a lot of different ways, in that scenario, if they really are like, no, one or, more than one's going to share it, then we talk about co-ownership agreements and putting that so that, there often is someone who emerges as kind of the
leader, and
the caretaker, if you will, or the leader of the cottage project. Yeah. And they'll kind of take the grunt of the work on, but we talk about how it's going to be funded and everything else. And, the different, capital expenses versus not, like how we're dealing with all of that.
Right.
Bringing that back to the will and sort of the equal versus fair is like, if that's not going to be split 3 ways or down the middle, then what are we doing about it, right? If it's really like no, and often it's one or two of the 3 use it more, right?
Yeah,
one doesn't even live anywhere close by. And so we want to keep it intact for these kids, but maybe not equally among all the kids. And then so we talk about, well, what does that look like, right? When you have a cottage property that's not your principal residence, there's often a fairly large gain, depending how long you've owned it. That's going to be a capital gain that's going to have to be dealt with when you die. So do you have enough liquidity in your estate otherwise, or can assets be liquidated in your estate otherwise to address that?
Right.
Because if not, then that cottage is likely going to be sold,
right?
Unless
to cover the capital gains expense.
Unless one or more of the kids is going to personally, meaning out of their own pocket, pay that capital gain to keep the cottage intact. So these are just really realistic things that clients often just don't, through no fault of their own, don't think about. They haven't. It hasn't crossed their mind the realities of the succession of the cottage.
Well, we've seen a case where somebody's drafted a will, and at the time of drafting, the house was worth, let's call it $1 million. The cottage was worth roughly $1 million, and then it had $1 million portfolio, and they had 3 kids. And so they just said, okay, this kid gets the house, this kid gets the cottage, and this one gets the investment portfolio. Well, guess what happened? House and cottage increased dramatically in value.
Yeah.
As compared to the investment portfolio?
Well, the investment portfolio they were using to live off of. So that was drawing down over time. And then guess what? They had to pay the capital gains out of the investment portfolio on the cottage. So the poor kid, right? And again, I don't think the person who wrote the will did it with that intention at all.
They were definitely not from Loopstra Nixon.
No, they were not. And again, I was shocked that somebody didn't maybe point this out to them at the time. But at the time, it was just an innocent thing that it seemed very equal, but obviously was not even remotely close to fair, because the other one, and they felt awful about it, right?
So they thought that they're divvying it up equally, but what they hadn't realized, and no one pointed it out, is that it wasn't a fair division.
And it's actually not even equal because, as Amy said, like the value at death is not the value that it was when they did the plan, right? And so
okay, but nobody knows the value of things upon death, right? So
of course, exactly.
Okay, so what are some best practices to avoid that or mitigate that?
So if that's what I would probably be like, in that scenario, have some suggestions as to how we can plan in a way that's not house this way, cottage this way, portfolio this way. But barring that or aside from that, if they let's say they really are adamant the cottage is going to this child. And I want to equalize it otherwise to the kids. That's what I want. There's various things you can do, including having provisions in the will that say, at the date of my death, the cottage is to be valued. And I basically want you create a mechanism of equalization in the will, right? So at the end of the day, it should be a value of 1/3 of equal value to each of my kids. So that's, to be counted, the value of the cottage is to be counted when we're talking about that value. But another thing we talk about a lot, because to your point, like the capital gains is considered a liability of the estate, which basically means whatever liquidity or whatever can be liquidated has to be used to pay that capital gain, unless
which
you
would
say
probably
otherwise.
include the investments, for example.
So we will often consider including provisions that say the recipient of the cottage needs to address the capital gains. If they want it, maybe it's not a buyout, because that's another option. You can just purchase the cottage from the estate. We don't, if the client says, no, I don't want them to buy it, I want it to be a gift of the cottage, well, then we talk at least about them effectively footing the bill for the tax. Because otherwise, sometimes can be the case that you can draft it all you want about equalizing, but if the money's not there, it's not there. And so, the tax has to get paid. And if it's not,
this is sometimes where
CRA
you see
will make sure they'll get their money.
Life insurance is a tool that's used to kind of address some of those estate tax type things.
Yeah. And, or like life insurance for sure. And then when we talk about like registered plans, like RSPs and TFSAs, of course, RSPs also have tax, but directing those to certain children because we know they're going to be the ones receiving that asset. We want there to be additional liquidity there to pay the gain on that asset.
Right.
There's always like a balance because ultimately the buck stops with the estate, right? That kid could disappear with the money and not pay the gain unless we've included that provision in the will.
Right.
So we'll often say basically the gifting of the cottage to this child, if this is the route they want to go down, is conditional on them making arrangements to pay the associated capital gain tax. And basically they don't make those arrangements, the trustee's not to transfer the cottage to them. And so it's like a condition precedent to that happening. So that's, one way to address it. But like you said, life insurance and other tools that can ensure there's enough liquidity to deal with the tax, if that's not how they want to address it, are critical to make sure that it's not overly depleting the rest of their estate in order to keep this cottage intact. Because of course, if you sell it, use the proceeds of sale to deal with some of the tax. So, all contingent on what is the value here and how long, some of these cottages are generational and
100%
through trusts and other structures, the capital gain's been deferred for many generations. And the buck kind of has to stop at some point. And so the tax is often surprising to people in terms of how much it's accrued in value.
Well, can you imagine, and actually here's a little topic on its own, it's just the communication around it, right? Because imagine if you haven't explained that to your children and then the one receiving the cottage is like, woohoo, got the cottage. Oh, wait, I have to pay capital gains. I was not prepared for that. Right? That's kind of shocking. So I know a lot of clients struggle with communicating maybe what's in the will, but that's an awful situation to be in to go, oh, I've got this big tax bill now.
Daddy and mommy always used to pay the bill.
I was
I
not
have to pay the
prepped
bill
for that. Or even the stuff. We were chatting with a client the other day, and it's just the stuff that has maybe value or sentimental value. Do you find, again, going back to equal and fair, like if you have one piece of jewelry that's really, really special and you haven't said anything about it, or if maybe it's a certain painting or maybe it's a boat, whatever this thing is, and it's not addressed, what do you, like, what happens?
There's a fight. There's a fight. I often hear like, oh, my kids get along great and everything will be fine. It's not always the case when you're gone, especially if there's like any amount of tension now that's typically not resolved once you're gone. So we certainly want to think about like the sentimental things tend to be what people argue about more than necessarily the high valuable things. I once had like millions of emails go back and forth over a family photo album, which, there's sometimes some obvious solutions. We'll scan the photos in and everyone will get digital copies. But people want to argue. But I think it goes back to your point, Amy, like I'm very big on not every client wants to do this, but I don't think it should be a secret what's in your will. I don't think your kids or your family or whoever it is should be finding out what's in there for the first time once you've died. That's just tends to not go over well.
Well, it can get misinterpreted too, right? Going back to the equal and fair, they might not understand why you did something a certain way. Again, with the best intentions, because this person didn't explain to those 3 kids what her intention was. There's hurt feelings. It's like, oh, you didn't maybe value me. It's like, no, I don't think that was the case at all, but you're not here to say it anymore. So
I'm big on, sometimes the dynamics don't always lend themselves well to a family meeting. That might be the best case scenario. But in even one-on-one conversations, it's always best coming from you. Than being explained to by a lawyer who, may or may not have known your parent and, doesn't know your family and doesn't know the dynamics. I've had clients write letters. They don't want to have the conversation. They find that's too awkward or too stressful. And so they'll write a letter like, here's
to
what
the child, this is what I wrote.
This is what I want. Hey kids, here's what I did and kind of here's why. Which I mean is not maybe not the ideal, but it's certainly better than nothing. But yeah, I mean, I think with business owners, that's when a lot of this complexity comes in, right?
Right.
I have more than one child. Let's just take the 2 kids scenario.
Yeah.
One kid's very active in the business, helping to grow it, the obvious successor.
Right.
And one is not. They have a completely different career.
Right.
They're not involved.
Right.
Which we see quite often.
Yeah, it's normal.
Very normal. And so then, we talk more on the corporate estate tax planning side of things, right? How do we structure this now?
Right.
Not so much waiting for death. What can be done now to try and set this up to be successful, right? And that often involves bringing in the active child into the business as a shareholder now. Often involves, if we're doing an estate freeze or the tax advisors are suggesting an estate freeze, maybe the involved child is going to have shares of the growth of the corporation, or they'll have a holding company or a trust that will have shares of the growth, whereas the current value is frozen. And so it's sort of like the value mom and dad have built up, we're going to equalize that.
Right.
But the future value is only going to get attributed to that one child. And then we have to deal with like control and voting.
I was going to say,
that.
upon the parent passing in that scenario, the child that's the shareholder, the liquidity to come up with the money for the value of that part.
Right. So often we'll it really depends on the structure and the situation, but often we'll make sure that there's like a buyout, right? And so, and whether that's funded by life insurance or what have you, or parent has redeemed those shares over the rest of their life. So there's really no value left, and it's all now personally held, which they can divide better. It's in their own personal investment portfolio.
That requires planning. Can't do that.
Shareholders agreements where it's clear that on death they are redeeming the voting shares. So those go basically back to the corporation, so that the involved child, is getting those voting shares, so that the uninvolved child is now not all of a sudden a voting shareholder.
So all of a sudden it's like, hey, wait, my brother who's a doctor is now my business partner.
Yeah, exactly. And I find this is another good example of updating the planning, because as maybe this is pretty early in that stage, and that involved kid is kind of just kind of fresh out of business school and just getting his feet wet or her feet wet. Different conversation than 10-20 years from now, where they're like fully in the business, fully involved. Maybe they already are a shareholder, and we're talking about them kind of buying out the rest or becoming involved with what's left of mom or dad's piece.
Absolutely.
The more planning we can do, and this goes outside the will, the more we can do as those different life stages of the business are occurring, the better everyone's going to be set up. And those are usually situations where there is a lot of family discussion. Here's what we're doing and why. And everyone's on board, and everyone understands it fairly well.
You guys are both really all about planning and communication.
Well, if you
so
think
much
about
planning.
it, I think a lot of people, again, when they sit down and they think about these things, they think of it like this and this and this. But by having another person kind of looking at it objectively, Jessica, I'm sure you point out all the time, like, have you thought of this and this and this? It's like, oh, well, maybe, no, I actually didn't think of that. You're right. That doesn't seem fair. That I didn't understand that part, or I didn't understand the tax implication. Yeah. I think people go in, again, with best intentions, and then when they realize how it might actually unfold, it could change the way they would actually write it down.
Yeah, absolutely. And again, that's what we're here for, right? That you have your advisors to help you, guide you through that process. And to your point, have you thought of this? Have you, these are things that you want to be thinking about. And, it goes back to the collaboration among advisors too, because, I'll often work with my tax partner and my corporate partners on this is a holistic plan. This is not just the wills. How are we building this into the shareholders agreement, the family trust, the corporate reorganization? I'm in several different discussions right now with clients on those types of topics, where it's like, we're thinking about next gen. It's not going to be equal, because that's not the dynamics of the business and the family. But we do want to make it somewhat fair. And what are our options to do that?
Absolutely.
Jessica, in the pre-chat to this episode, you said something along the lines of, you don't want to punish your successful children. Can you talk about that a bit more?
Yeah.
That one caught my attention. I don't know why.
Yeah, no,
that's
I
a good
mean,
one.
it's a good question. So, I mean, like, you know, taking the same example, maybe that child that's not involved in the business, maybe they're not on their own as successful, right? And maybe mom and dad are giving them, you know, financial assistance over the years.
And this is as adults even.
As
right?
adults
Okay.
even. We really need to, like, that's really important information for us to know and for us to consider and plan around as well, right? So, you know, on the one hand, you have people who are like, well, when I'm gone, my estate has to continue to support this individual or individuals. Like they're not going to be able to support themselves the way that I have supported them when I'm alive. And I need to make a plan to do that. And so that might involve a trust in the will or other things where we're making sure that let's say it's an adult child is funded. And sometimes that means diverting assets away from one or more of their other children. And so it's not equal in that situation. And one thing I just highlight to them is that's fine. Like, you know that this is not going to work out to be equal. And they say, yes, this person needs it more. My other kids are okay. They're successful in their own right, whether it's through the family business or otherwise. Yeah. I know they've worked very hard for that success, but this child needs it more. And I just say, like, you want to make sure you're not penalizing your successful children for making, you know, different life choices or for being able to be successful. Right. They've worked hard for that. And so you need to balance that with maybe the other kid or children who are not as successful and might have more needs, right? The way part of the challenge there is when you have, you know, in legalese, what's called dependence, when you have people that are financially dependent on you for support, then you get into concerns about, well, if you don't provide enough for that person, you know, what claim could they have against the estate for that kind of support? Right. And so that's, you know, something that we're always balancing, and we want to make sure getting the right advice, whether it's from a family law lawyer or otherwise, to make sure that we're properly considering all of that.
In your practice, have you seen feud or resentment from the successful child towards his non-successful, quote unquote, I don't know, quote unquote non-successful sibling? Like it does cause drama? It
happens, right? Every family is different. Every dynamic is different. But, you know, I'm sure you guys have heard it too. Like, mom and dad always did everything for them. Nothing's changed. Now they're gone and it's the same thing, right? You know, it's hard, like, even as a parent, like, you know, kids are going to be different. They're going to have different needs. And I think as a parent, it's tough because you might want to be equal. But that might not be the fair outcome. Right. Like, and it's hard. We want to balance that. And it goes back to, like, I'm typically in those situations, I'm very big on, please have the conversation with the kids now. It can be separately, but make sure they have an understanding of why you're doing it. Because they will appreciate it. I tend to see, at least, that they appreciate much more the thought process behind it when they've heard it from you. 100%. And not kind of explain to them after the fact, right? And honestly, the flip side of your question, Jalal, is like, I do see it's very heartwarming. Like, a lot of families, you know, the other sibling will be like, of course.
Like, they understand. Like, there's an understanding there, right?
And frankly, they know that they themselves are going to have to help support that other sibling as time goes on, right? And so they fully understand it, and that's not every family, but most of the time, you know, and I think that those conversations go a long way in helping get to that result over the scenario of resentment.
Well, I think you do a great job, Jessica, bringing that out and making sure that, again, equal versus fair, but at least they're considering their options and making, you know, going in eyes wide open. And the communication part is, I think you do an excellent job getting people to have those tough conversations. And you do it in a great way that it doesn't feel awkward and uncomfortable. And, you know, you're always a pleasure to talk to. So thank you again for making the time to come in today.
Thank you. Thanks for having me.